Buying the FTSE 100 versus picking stocks. Who wins? Everyone's heard of the FTSE 100. But behind that tidy number lies a hidden world, where companies rise and fall like contestants on a reality show. Billions of pounds change hands daily, and professionals play a high-stakes game of financial chess with real money. In this video, we're diving deep into what the FTSE 100 really is, how it works, why it exists, and how even professional traders use it to make massive decisions. And stick around, because we're also going to answer the million-pound question. Is it smarter to invest in the FTSE itself, or the companies inside it? You might think you know the answer, but what you're about to learn might just flip the script. What is the FTSE 100? The FTSE 100, or FTSE, if you're feeling casual, is a stock market index made up of the 100 largest companies listed on the London Stock Exchange, ranked by market cap. Think of it as the Premier League of the UK stock market, filled with financial heavyweights like Shell, HSBC, and Unilever. These aren't your local corner shops. These are corporate juggernauts. When the FTSE 100 goes up, it usually means those big players are gaining value. When it drops, cue the nervous headlines and sad violin music. It's a sign investors are worried, or that performance is dipping. It might look like a simple number, but it reflects the economic mood of the entire nation, and sometimes the world. Origins of the FTSE 100. The FTSE 100 was born in January 1984, a love child of the Financial Times and the London Stock Exchange. FT plus SE equals FTSE. Not the most romantic combo, but hey, it works. It was designed to bring a bit of order and modernization to a chaotic market. Back when shoulder pads were in, interest rates were wild, and Margaret Thatcher was privatizing everything that wasn't nailed down. On day one, the FTSE 100 started with a base value of 1,000 points. Simple. Clean. Iconic. A base value is basically setting the scoreboard to zero before the game starts. For the FTSE 100, that base of 1,000 means that on launch day, the total market value of the top 100 companies was benchmarked to 1,000 points. So if the FTSE is sitting at 8,000 today, that means, in very simple terms, the value of those companies has grown eightfold since 1984. Which is either amazing growth or a very polite reminder that inflation is undefeated. Just remember, the FTSE isn't a stock price. You can't buy one FTSE. It's a tracker. A giant, moving scoreboard of corporate muscle. Why the FTSE exists. The FTSE 100 gives investors a fast snapshot of how the UK's largest companies are performing. No spreadsheets or crystal balls required. Instead of checking 100 charts like an overworked analyst hopped up on coffee, you check one number. It also paved the way for index funds and ETFs that track the FTSE, sparking a revolution in passive investing. It's like buying a basket of Britain's biggest businesses in one go. No fuss, no guesswork, no awkward calls with your stockbroker. Without it, investing would be slower, more expensive, and a bit like doing a group project with 100 CEOs and no group leader. What if the FTSE didn't exist? Without the FTSE 100, we'd lose one of the most reliable benchmarks in the UK financial system. No FTSE tracking ETFs. No easy way to gauge the market's mood. No catchy headlines like, FTSE falls on fears of flying ferrets. Okay, maybe not that last one, but you get the point. Without it, traders would have to rely on more fragmented data, and investing would feel like trying to complete a jigsaw puzzle with half the pieces missing. How it's used in trading. So, how do traders actually use the FTSE? As a market mood ring, if the FTSE is rising, it's a sign of confidence. If it's dropping, someone somewhere just spilled coffee on their Bloomberg terminal. For strategy timing, traders might shift into defensive stocks like utilities or healthcare when the FTSE starts to wobble, aka the financial version of grabbing an umbrella when you smell rain. For global comparison, they pit the FTSE against other big indices like the S&P 500, the DAX, or the Nikkei. It's like comparing Premier League teams, but everyone's wearing suits. This isn't financial advice, just a peek into how the pros think. They don't predict the future, they just try to look very clever while guessing. Should you buy the index or individual FTSE stocks? Now for the spicy debate. Some investors love picking individual FTSE 100 stocks, betting that individual companies will crush the competition and deliver big returns. But here's the twist. Companies can fall out of the FTSE 100 if they underperform. So if you're only holding a few stocks, and one drops out, you could be left holding the financial equivalent of a floppy disk. Others prefer buying the whole index through a fund or ETF. It's like buying the entire football team, so if one player has a shocker, the others can still win you the match. Plus, the FTSE gets rebalanced every quarter, so weaker companies are swapped out for stronger ones. Passive investing doesn't mean inactive. The FTSE's got bouncers at the door. So the real question becomes, do you want to bet on individual players, or on the whole team? There's no one-size-fits-all answer, just different strategies, different risks, and different levels of heartbreak. Professional traders have their own toolkit, and it's not for the faint-hearted. Index futures. Want to bet on where the FTSE will be next month? Futures let you speculate, without buying a single share. Warning. It's basically financial time travel, and it comes with turbulence. Hedging. Own UK shares but smell trouble? Shorting FTSE futures can protect your portfolio. It's like an insurance policy, with caffeine. Day trading and scalping. Some traders go in and out of the FTSE like it's a revolving door, trying to profit from micro-movements. Blink, and you'll miss the trade. This stuff is fast, technical, and often involves more screens than a NASA control room. Let's finish with a few gems you can use to impress your mates at the pub. It's not 100% British. Many FTSE 100 companies make most of their money abroad, so global events often move the index more than anything happening at Westminster. It's reshuffled 4 times a year. In March, June, September, and December, companies are kicked out or welcomed in, like a financial game of musical chairs. You can't buy the FTSE itself, only funds that track it. So no, you can't just walk into a shop and say, "I'll take one FTSE, please." Comebacks happen. Companies that fall out of the index can bounce back in. It's not the end, just a dramatic plot twist. So, the FTSE 100 isn't just a number. It's a mirror for the UK economy. A battleground for professionals. A benchmark for the rest of us. And occasionally, the source of mild panic at 9 a.m. when the markets open. Now you know where it came from, how it works, and how investors, from beginners to hedge fund heroes, use it every day. If you found this breakdown helpful, and hopefully entertaining, hit that like button, subscribe for more deep dives, and drop a comment below. Would you rather own the entire FTSE, or just pick your favorites from inside it? Let's debate it in the comments, and I'll see you in the next one.